So today I want to talk to you about if buy-to-let investing is still worth it, if property investing more broadly is still worth it. Should you sell up as a landlord or hang tight? Should you even bother investing in property to begin with? Or should you invest in something else entirely, like stocks, commodities, or crypto? My goal for you by the end of our chat is to have a stable, objective perspective on the pros and cons of property investing. Because despite countless news headlines and YouTube videos suggesting buy to let is dead, let me firstly remind you that the Chancellor herself, Rachel Reeves, rents out her 4-bedroom home for around £3,200 per month, and her husband has been renting out his central London 2-bed flat for around £3,000 per month since 2011. So clearly they are of the opinion property is a good store of value. Otherwise, why not sell? But before we get into it, in case you don't know me, I'm William Gale, and I've spent since 2012 building a UK-wide home buying company, British Home Buyers, a nationwide estate agency, British Home Sellers, that's dealt with over 13,000 transactions totaling over £3.3 billion of property. So reading the market correctly is essential to mine and my client's success. So let's start with why the buy-to-let market is shrinking. Since pre-COVID, Zoopla estimates there are 24% fewer rental properties in the market, despite the fact rental demand has actually increased 68% since pre-COVID. And I think a lot of people think this triggering of buy-to-let landlords leaving the market is a post-COVID problem. But in reality, it isn't. As you can see from this graph, the red line shows the percentage of landlord purchases against total purchase volumes. And you can see it has been dropping ever since 2015. In reality, actually increasing a little over COVID to now falling again. And the sale of buy-to-let property, that dark blue line you can see there, has been rising a lot as a consequence of really the last financial crash, all the way back in 2007, 2008. More recently, since 2016, dropping a little and increasing a little, but staying relatively flat. So it's really important to acknowledge the shrinking of the buy-to-let market is nothing new. It's been a trend for 8 years now. And in fact, it was the last Conservative government that began reducing the incentives and the attractiveness of property investing to begin with. Just take a look at this graph. You can see how the buy-to-let market was increasing and increasing as a percentage of the market significantly. And then when the extra 3% stamp duty was introduced in 2016, that started to trigger the dampening down of the buy-to-let market. And that continued as Section 24 was brought in, the tenant fee ban was introduced. And now with the 3% stamp duty increasing to 5% and the introduction of the Renters' Rights Bill, it is quite clear the buy-to-let market as a percentage of the market will absolutely keep dampening down. And that is demonstrated by how Rachel Reeves dealt with the introduction of the 5% extra stamp duty policy more recently. Because of course, I hear people say it's mad how she gave no notice on increasing it from that 3% to 5%. But it's clear the reason she didn't is because notice was given before the introduction of the original 3% stamp duty, and that created a massive spike in buy-to-let transactions leading up to it because people wanted to beat the deadline. So I get the impression she deliberately wanted to avoid that pressure on the market. The Labour government really are focused on dampening down the buy-to-let sector at all costs. But does that mean the buy-to-let market is dead? That property investors are all screwed? Well, no. The buy-to-let market is shrinking and will keep shrinking because all the government interventions are ultimately designed to make property investing less profitable to ease demand, making it more likely people decide against property investing and invest in something else entirely. And if we're all honest with ourselves, what's best for society is not that people's homes are an ultra easy and profitable way to make money. Just being able to buy anything and rent it out at a profit, which is really what the market had become. I believe the profile of the property investor is changing for the better. You have to bring in more value as a property investor, in my opinion, in one of two ways. One, either you bring in more cash. So one of the primary ways the profile of the property investor is shifting is through increased financial resilience. In today's market, investors who bring more of their own cash into property deals are generally in a stronger position. And here's why. Firstly, there's less dependence on financing. Higher cash contributions mean less reliance on high interest rates, interest rate mortgages, which can be volatile in today's rates environment. Investors who can reduce their loan to value ratios or even purchase properties outright avoid the impacts of rising interest rates and all of the associated cash flow pressures that go with that. Next, makes you more competitive in the market. Cash buyers are going to be more competitive, have an edge, especially when buying distressed or under market properties where a seller might prioritize a cash offer at a lower price to get a quicker sale in certain situations. And next, higher yield potential by reducing the amount of debt servicing. These investors with cash can keep a large proportion of rental income as net profit because they've not got a mortgage to pay. This is particularly advantageous as rental demand rises and yields grow in certain high demand areas. So in a market where government policies are squeezing profit margin, having a strong cash position allows any investor to ride out these tougher financial climates that we're going through, gives you flexibility in how to approach property opportunities and make long-term gains that rely less on debt and more on the fundamentals of property demand and supply, if that makes sense. Or if, as an investor, you can't bring in more cash to offset the tougher market, you can secondly focus on adding value to properties by things like renovating properties, improving the condition of the property to create a better living space for tenants, for instance. This isn't just about cosmetic stuff, but could involve more significant upgrades to things like energy efficiency, which obviously all those things are going to align with government standards in the future. You can convert properties, for example, converting single family homes into multi-let properties or repurpose commercial spaces for residential use. So these sorts of conversions not only address the housing shortage, but often provide you higher rental yields that obviously is good for you as a landlord. So what does this mean for new and existing investors out there? For those new to property investing, this challenging landscape is obviously going to be intimidating. It requires more upfront money than before, more knowledge, and often a willingness to take on property improvements. However, for those willing to bring this added value to the market, the rewards can still be substantial to you. In fact, investors who understand how to enhance a property's value through renovation or development are those that are finding the most success at the moment, almost always outperforming those who are just solely buying a vanilla buy-to-let property and renting it out. On the other hand, if you're an existing landlord or contemplating expanding your portfolio, now is the time to really assess your strategy carefully. Holding on to properties purely for rental yield might not be as effective as it once was, especially with all of the increased operating costs and tax burdens that are coming our way. But by adapting, whether through upgrading those properties to add value, rethinking your rental strategies, or focusing on long-term capital appreciation rather than the short-term cash flow, can still make property investing work for you. So is property still a good investment compared to stocks, commodities, and crypto? Well, property investing may be less straightforward than it was before. It still remains a solid long-term investment with unique benefits. So unlike stocks, property is a physical asset that you can improve upon. Unlike crypto, property has lower volatility in the market. And unlike commodities like buying gold, property offers regular income through rent. So even if yields are reduced in the short term, they're still going to be okay over the long term. Ultimately, it's about aligning your investments with your risk tolerance, your goals, and the current economic climate. So stocks might offer fast growth, but with greater risk. Commodities can hedge against inflation, but lack the stability of property. Crypto could yield you a really high return, but demands a very high risk tolerance. I'd be interested to see what you guys think on all of this. Comment below, and as you know, I always reply to practically all your comments, and I'll see you in the next video up here.